On the 30th of April 2026, the Bank of Japan intervened in FX markets when the dollar-yen exchange rate crossed their line in the sand here at 160, initially causing price to drop significantly from just above that 160 down into 155. But why has price not continued to move lower? Why did we not clear and break below 155? And in fact, why are we now back up at actually 159? My name is Ray Gilmour, and in this video I'm going to show you exactly why price did not continue down through the 155 level and actually is now back above 157 and now on to 159. To begin with, I'm going to take a look at the intervention so everybody understands where we're at. Japanese yen had reached $1 billion in buying to defend that level and to strengthen the Japanese yen and effectively take that exchange rate, that dollar-yen exchange rate, lower and away from that 160 level. It's not the first time it's done that. We have been here before. 2024, we've seen a very similar intervention when price temporarily got above the 160 level, and we've seen a big reaction from that point. But we're seeing a very different reaction here in 2024 than what we've seen now in 2026. And I want to explain to you why that is, because we can actually see the data and the activity which is causing this. And it's really important that you understand why it's occurring. To explain it, I'm going to use the Japanese yen futures chart because it makes a little bit more sense. When we're looking at the dollar yen chart, when price is moving up, that's the dollar getting stronger against the Japanese yen. And whenever it's moving down, that is the yen getting stronger. The inverse, and it's much more easy to understand, is the futures chart, but you can see the same level of support we have here on the futures chart corresponds to that 160 level on the dollar yen. The only difference being that whenever this chart is moving down, when the price is moving down, that's the yen getting weaker. That's traders selling the Japanese yen, and when it's moving up, that's traders buying the Japanese yen. So it's going to be much easier to understand and explain. So let's go back to 2024, when we seen the very similar instance. We were back at this level of support, and we had been in a significant long-term downtrend prior to that point. Since the beginning of 2024, so it was a 6 months downtrend. This was driven predominantly by selling, speculative selling, driving the price lower, and we got to the point where the Bank of Japan said this is enough is enough. We can't tolerate our currency being weaker than this. We need to do something about it. We need to step in. Now, to understand why we haven't reacted like that, now I want to go through just the mechanics and the mechanism of what's going on here. If you're a trader and you've been short in a market and heavily short in a market and made a lot of money short in that market, when you see a central bank stepping in and say, okay, this is not acceptable, we're going to defend, we're going to buy the asset, we're going to take the price higher. The first thing you do whenever you're short of an asset, or the first thing you would expect to do, is to start closing those short positions. Closing those short positions is effectively a buy in the market, and you start to see price going up. But a lot of that early momentum is driven significantly by people who have been previously short, closing those positions and actually then exiting the market. And also then you obviously have buyers as well. But a lot of the early movement is that those people who were short actually closing those positions, exiting, and then we see a slow switch into longs, helping to take the market much higher. The problem is this time around, that hasn't happened. This time around, we got an initial spike, but prices continue to move lower. And the reason why that has happened is because traders who were short are still short. And how do I know that? I know that because this is recorded. Trading positions are recorded. If you're not familiar with this, the record is known as the commitment of traders, and that records every active position in the market. And we're able to see who's buying, who's selling, who's exited those short positions. And what I'm going to do is go back here again. Here is the 2024. That was the low we were just looked at initially, where we've seen the big move to the upside. And I'm going to be focusing predominantly on the speculative side here. We're going to be looking at those speculative traders who were short Japanese yen during that downtrend. This was the beginning of the year. We've seen that downtrend accelerate, but it actually been in a downtrend for a longer period. Those traders who had been short, here is the amount of selling that they're doing. The quantity of selling. This red line shows the number of positions, the futures contracts, the number of contracts they're holding, and you can see it continuing to increase. Whilst the downtrend is going on, they're continuing to add, sell more and sell more and sell more. And just to give you some context, if we zoom out, it was only the second time ever that traders have ever got as much short of the Japanese yen as what they have. The last time was back here in the mid 2007, actually an interesting time for it. But that's the only other time. So a very, very significant level of shorting had been reached at that point in time. And now, as I said, as I explained previously, whenever traders are short a market, the central bank steps in, the first thing you'd expect them to do is to start cutting those shorts. And that's exactly what they did. You can see the red line is the amount of selling, the amount of short positions that they're holding. And they cut each of these. It's a weekly chart. And you can see there's the first week of the move. We had a cut, we had a drop down. And there's a second week down here. Third week, big drop in here. And you can see the way price is accelerated through that point, but a big drop in the short contracts. And then by the fourth week, huge drop. So in 4 weeks, they've went from the extreme highs of having one of the largest short positions we've ever had to 4 weeks completely removing that short position. That requires a lot of activity, and that's what's driven that market forward. Big problem this time around is they have not done that. Yes, the Bank of Japan has stepped in and they have intervened, but we can't be focused on the headlines. We need to actually look at what's going on underneath the surface and what's actually happening. How have traders responded? A market will move not because of intervention. It's because of how traders perceive that intervention and how they need to position themselves as a result. And if we can see here, looking at the short positions, initially we got the initial spike. The short positions did drop from a reasonable high level, not as high as we were back here in 2024, but a pretty high level. We got an initial drop, which is why they're pricing that initial spike. But they have not continued to drop the way they did back here in 2024. And not only did they not drop, they actually increased their shorts again. They increased their shorts. And in combination with cutting shorts, you'd expect traders to be adding to longs whenever we're seeing this scenario and a change of trend. And same with what you maybe expect to see here, cutting shorts, adding longs. If we add on the long contracts here and actually look, we can see that back at this point, they were indeed adding to longs. Okay, slowly adding to longs and aggressively cutting those shorts. This week, we have seen they not only have they not cut their shorts, they've actually increased shorts, but cut longs. They're a complete opposite to what most people would expect to be the case, particularly in the retail sphere. Retail's very much focused on the headlines, seeing the Bank of Japan has intervened. Dollar yen is going to drop away from that 160 level down much lower, just like we did in 2024. And that's not the case. Now, I'm not saying that can't happen or it's not going to happen. What I'm saying is don't follow the headlines. Don't just see a headline and think, well, this must happen now. You need to see what traders are actually doing, how traders are taking that information and what are they actually doing with it. Where is the real money going? And at this point in time, traders are saying they are sticking with what they believe is the right thing, the right side of the market to be on, regardless of what the Bank of Japan say they're going to do. So it looks like we're heading back to 160 again. Back to that 160 level. We've broke up through back above that 157. We're already at 159. It looks like we're very much heading to that 160 area. Can we break through it and really then push the Bank of Japan to take some significant action? We shall see. But don't just look at the headlines. Look at what traders are doing. And the information is there. The data is there. We get to see it through the commitment of traders. It's a very, very unique report. It's the only way we actually get to see a record like this. So if you want to really know what's going on in any market, whether it be FX, commodities, etc., take a look at the numbers, see what's really going on, and decide for yourself based on facts as opposed to headlines.